Wall Street Journal just reported on a massive downturn in the US rental market that could have a significant impact on both where rents and home values go over the next year. This downturn in the rental market is historic. We're seeing the lowest rent growth in over 13 years, and this is something that's now causing landlords and big investors across America to go into a panic. And this story is something you all need to be paying attention to because the rental market and the home sale market are very related. You can see this Wall Street Journal article is talking about how the rise of accidental landlords is bad news for investors who bet big on rentals. Problems in the for sale housing market are starting to infect the rental market. And this is the big chart I want you guys to focus on from John Burns Consulting. It's measuring single family rent growth year over year. You could see it was 11% in 2021 during the boom. Well, now rent growth is down to a measly 1.5% year over year. That's the lowest level of rent growth for single family homes in the last 13 years. Since the last crash in 2011, we have the lowest rent growth since then. And John Burns Consulting, they're forecasting rents are only going to rise 0.8% this year. And this is ultimately bad news for landlords in America, particularly the landlords who bought at the peak of the pandemic in 2021 and 2022. They were banking on continued rent growth going forward. It looks like the opposite is happening. We have rental disinflation occurring right now in the second half of 2025, and we could even have rental deflation in 2026 because these rents, folks, they're dropping a lot in certain markets already. We're seeing apartment rents collapse in cities like Austin, in cities like Fort Myers. In some of these markets, everyone, the rents are down 15 to 20%. And why this is relevant for you, if you're a home buyer especially, is that if the rents are dropping or not growing, that's going to mean that the for sale housing market is also going to drop because rents feed into home prices. And I'm going to show you a lot of data in this video overall, but the main takeaway here, folks, is the rental market is very correlated with the for sale housing market. And I'm going to show you one area that's gone down a lot in rents already that I think you need to pay attention to. That's Austin, Texas. You could see here on this graph, which is measuring data from Apartment List. Apartment rents in Austin are down 20% from peak over the last 3 years. Apartment rents in Austin are now almost back to where they were before the pandemic. So there's been a big rental downturn in Austin. But what about down in Florida, everyone, in a market like Fort Myers? You can see Fort Myers rents have absolutely plummeted by about 20% from peak. And if we take a look over here, everyone, you can see the markets according to Apartment List where apartment rents have dropped the most. Austin, 18%, Fort Myers, 15%, Colorado Springs, 12%, Santa Maria, California, 12%, Northport, Florida, 12%, Phoenix, Arizona, 12%, Myrtle Beach, 11%, Naples, 11%, Huntsville, 10%, Asheville, 10%. And you can see these rental declines are even spreading into markets like Raleigh, Lakeland, San Antonio, Pensacola, Atlanta. And as this video goes on, folks, I'm going to take your requests here to look at the rental market in your area. But ultimately, folks, I think we could be seeing deflation in the housing market overall. You know, we've seen in the last year how home values have started to drop in half the country, right? Well, now that rents are starting to drop in half the country, and now that rents could be going negative on a national basis over the next quarter, that's a signal of like potentially a nail in the coffin on the housing market. Because about a quarter of all homes in the US are owned by investors. 25 million homes roughly are owned by investors. And the reason they own these homes is so they can rent them out and get cash flow. Well, what do these investors do if their rent has to get cut? What do these investors do if the property taxes and insurance go up by more than the rent? Well, many of these investors will stop buying. Many of these investors will sell. In fact, this is already happening. I've talked to you guys for the last year and a half about how investors are selling off on the US housing market. I was actually the first one to break this story about the rental market slowdown about a year and a half to 2 years ago, and talking about how investors would stop buying and start selling. Well, we're seeing all of that data continue into the future, and it's great news if you're a potential home buyer. It's great news if you're a renter, right? I know if you're a renter in a lot of markets, you say to yourself, like, I didn't even know that rents could go down. I didn't even know that rents could stop growing. Well, that's exactly what's happening in the current environment, which is great news for renters and renter affordability. Not so good news for landlords. I think we're going to have to see many of these landlords be forced to sell over the next 6 to 12 months. We're already seeing that happen in states like Florida and Texas. We might see that spread to more areas. And I just want to dig into this data a bit further and report from the Wall Street Journal here on the rental market, because it can be a bit counterintuitive, right? Because I know certain people say, shouldn't rental demand and rents be going up because mortgage rates are up? Because the idea is higher mortgage rates should cause more people to want to rent. And that's true to an extent, but there's another thing actually occurring here. And it's the fact that regular homeowners who can't sell their properties are now renting them out instead. And that a growing number of accidental landlords is now becoming a headache for Wall Street investors. So the idea is, like, just think of a normal couple. They might go to sell their house this summer. They didn't sell their house this summer, and then they pull it off the market and they put it up for rent. According to data from Parcel Labs, 3 million properties were listed this summer for sale. Only 28% sold. So that leaves 2 million homes left on the market, a fifth higher than last year. Many of those are switching to rentals. So the rental inventory is going up, and going up by a lot in different markets, which is pushing down the rent. Another issue for the rental market, everyone, that we should talk about is immigration. So the immigration levels into the US are plummeting in 2025 due to the policies of the Trump administration. If you look at data on border crossings are literally down 90%, 95% from where they were a year or two ago. If you look at data on immigrant work applications, it's plummeting. And ultimately, the reduced immigration doesn't have an immediate effect on the for sale housing market, because generally speaking, immigrants don't run in and buy homes, but rather it's having a bigger impact on the rental market. So there was this period in the middle to late of 2024 when there was a surge in rental demand, when the rental absorption was really strong due to the big push in immigration that had occurred. Even in the beginning of 2025, the demand for rentals was still strong. But it seems like in the last 3 to 6 months, the demand for rentals has dropped a lot. And I think it's due to the immigration. And one metric here that I'm actually looking at that I think could help you guys understand what's actually going on in the rental market. We'll see if this data actually loads. Yeah, here we go. This is data from the Brookings Institution on work permit applications among eligible immigrants. You could see that work permit applications among eligible immigrants skyrocketed in 2023 and 2024. We actually had a record number of work permit applications for immigrants in March of this year. 6.3 million annualized rate in work applications for immigrants. But take a look at what's happened in the last 5 months. The work application for immigrants has plummeted by about 60 to 70%. And the reason I'm showing you guys this data is so you can know what to expect in the future in the rental market. We're seeing the early signs of this downturn in the rental market, right? We're seeing John Burns Consulting show how the single family rent growth is now down to only 1.5%. Lowest level in 13 years. Well, where is it going to go into the future? I think with the downturn in immigrant work applications, the downturn in the labor market, the downturn in non-farm payrolls, we're going to see continued reduction in rental demand over the next 6 months. Now let's translate that, what that means for you as a home buyer. Continued reduction in rental demand means we're going to see rent growth continue to decelerate. We're going to see rent growth go negative, go further negative in many markets. And as rent growth goes further negative in many markets, that has two benefits for you as a home buyer. Number one, if you are currently renting, if you're a first-time buyer, It's going to mean you have less pressure to buy. It's going to mean you might actually see cheaper living costs. If you're in one of these Sunbelt markets, like in Austin, like a Dallas, like in Atlanta, like a Phoenix, like a Vegas, and your lease is coming up, you have a lot of negotiating leverage with your landlord right now because the vacancies are going up, the rents are going down. So if your landlord tries to increase the rent on you, it might be smart to try to negotiate with that landlord and take a look and see like what other listings there are for rent. Because if I just look here in Nashville, right, and I go to Zillow and I look at the rental market in Nashville, you could see that we have a lot of apartment properties with like 77 units available for rent. We have properties with 176 units available for rent. There's a lot of options out there. And, in a lot of cases, they're giving what's called concessions. Like on this apartment in Nashville, they're giving you 3 months free to rent there. 3 months free to rent at this apartment in Nashville. And these rental concessions are becoming more and more common in a lot of different housing markets, these rental concessions. And it's essentially free rent. So if you do a 12-month lease and get 3 months free, that's a 25% rental discount. And that's not even included in the data I was showing you before on how much the rents have dropped in certain markets. Like if we go to Nashville here on this data from Apartment List, you can see the rents are down about 8% from peak on median rent. But that doesn't even include concessions. So if you include concessions, the net rent is down even more. And ultimately, what's driving this, everyone, is vacancies. So the x-axis here is the vacancy rate for all the different apartment markets, how much it's gone up the last 3 years. The y-axis is the rent growth. So you could see the markets with the biggest declines in rents here in the bottom right are the ones with the biggest increases in vacancy. So the vacancy rate in Austin's up 3.7% in the last year, and in the last 3 years. The rents in Austin are down 18.3%. In, let's say, Colorado Springs, vacancy rate's up 3%, rents are down 12.5% for apartments. In Northport, Sarasota, Florida, vacancy's up 7%, rents are down 12%. In Asheville, North Carolina, rents are down 10%, vacancies are up 5%. So these markets here, great news if you're a renter, great news if you're a home buyer. Declining rents is great news if you're a home buyer as well. It means a softer market, it means a deflationary market, it means a market getting cheaper overall. It's a market that investors are going to be more likely to sell in with declining rents. It's ultimately just a further signal of the housing market slowdown when you see the rents declining. Interestingly though, folks, the rents aren't declining everywhere. There are some markets here where the rents are going up. Hartford, Connecticut, rents are up 11% the last 3 years in Hartford, Connecticut. Providence, Rhode Island, rents are up 8%. Chicago, Illinois, rents are up 10%. And if we go back to this chart here and scroll to the bottom, we can see Anchorage, Alaska, rents are up 16%. South Bend, Indiana, rents are up 13%. This is the last 3 years, September 2022 to September 2025. Hartford, Lansing, Michigan, rents are up 11%. And so it's a very similar story here in the rental market to actually the for sale housing market, right? Like where are home prices up the most over the last, 3 years? Where are home prices up the most over the last 3 years? It's going to be in markets in the Northeast, right? So if we look at the home value growth since the middle of 2022, where are home values up the most? They're up 21% in Connecticut, according to data on Reventure app. Home values up 21% in Connecticut. They're up 11% in Indiana. They're up 12% in Illinois. But where are home values down the last 3 years? They're down in Florida. They're down in Texas. They're down 7.7% in Arizona. They're down 7% in Idaho. And so this for sale home prices, home values, looking very similar to the rental market. And that's just something I really want you guys to understand. I'm going to get in your requests here in a second. But I just want you to remember what ultimately determines home prices in the long run is rents. Like they're related, they're heavily related. Rents and incomes filter through to home values. I talk to a lot of aspiring real estate investors who ask me questions about like when they should get into the market. And these aspiring real estate investors, often want to buy a house and rent it out, buy a house for cash flow, right? So when you do that calculation, when you do your pro forma calculation, especially if you're an investor, you're going to be looking at what those rents are. You're going to be assuming what those rents are growing by in the future. And if the rents are stagnating or dropping, it's going to lower what you can pay to buy for that house. And one argument I just hear a lot recently, more recently, is people who try to say there isn't a housing downturn or won't be a housing downturn. They try to say that the reason there won't be is because of asset inflation. This is kind of the common narrative now I hear from housing downturn deniers, right? Like, it's getting harder and harder to deny that there's a housing downturn. Homes for sale are way up. Prices are going down in half the US. In many markets, it's obvious, like Florida. Florida's in a crash right now. So it's getting harder and harder to deny that. But what I see certain people starting to say is, oh, well, look at how much gold has gone up. Look at how much Bitcoin has gone up. And they say, well, because gold and Bitcoin have gone up, that's asset inflation. Thereby, they say home prices are going to go up or home prices won't go down, is the logic. Other people also try to say that the value of the US dollar is declining, and that if the value of the US dollar declines, that's going to mean inflation and inflation for the housing market. Those are some narratives I just consistently hear lately. You guys can let me know whether you've heard those narratives. But I want to address those head on and explain to you again, fundamentally, why I don't believe those narratives have any weight in terms of determining where home values are heading in the future and where the housing market's heading in the future. And it's because the only inflation that matters for home values is rental inflation and wage inflation. Rental inflation, rents going up, that causes home prices to go up intuitively, right? If rents go up, well, then landlords are going to pay more. Investors are going to pay more to buy houses. If rents go down, landlords aren't going to be able to pay more to buy houses. They're going to lose money and be forced to sell, right? And then you have the wage component. If wages go up, that means home buyers have more money to spend on homes. But if wages flatline or go down, then they wouldn't have as much money to spend on homes. And I just want to show you kind of the long-term chart here so you can understand it. We have here about 75 years of data. And the blue line on this graph is the home price growth year over year, according to data from Zillow and the Case-Shiller Home Price Index. And we're going all the way back to like the 1950s. And you can see home price growth is very volatile, everyone. Look at how volatile home price growth is, right? It actually rarely kind of stays stable. It has these swings up, these swings down. Then you see in 2005, there was a swing up, then there was the big crash, then there was like the pandemic, and now it's slowed down a lot on the home price growth. But take a look at the orange line. The orange line is the rent of the primary residence according to the BLS CPI, the growth in rent. And you see the growth in rent is much more stable. The growth in rent doesn't like boom as much, it doesn't crash as much. But what you can notice is like the 1970s. Why was the 1970s such a big period for home price growth? Well, it's because rental rates just kept going up. Rental rates kept surging throughout the decade, peaking at 9.3% rental rate growth in 1980. So you just see this consistent upward drift on rental rates throughout the 70s and 80s, the last time we had real inflation in the US housing market, like legitimate inflation. And then you see rent growth kind of goes down from 1981 all the way to 1992. And what happens as rent growth goes down? Home price growth then moderates, right? And then the way you were able to spot the bubble in the late 90s, early 2000s was the fact that home price growth went way above rent growth, right? That's what tipped you off to the bubble. Then home price growth crashed below rent growth. And then we had a similar situation in the last 10 years. Home price growth surged above rent growth. We did have a legitimate increase in rents during the pandemic, but now that rental increase is decelerating heavily. The census now says rent growth is 3.5%. John Burns is saying it's 1.5%. And the overall point is here, folks, if rent growth is decelerating, we are not going to see home price growth bounce back. If rent growth is decelerating, that's telling you the direction of the market. It's a supply and demand equation for the housing market overall, both for sale and for rent. And the reason why, everyone, again, to go back to this Wall Street Journal article, is these accidental landlords, right? So people are going to sell their house, right? And this is actually kind of interesting. I'm just going to read here what the Wall Street Journal is saying. This situation isn't what investors had penciled in. Owning single family homes should be a sure bet because so many young families are priced out of the market and stuck renting. Tenants' finances also look healthy based on rent to income ratios, and occupancy rates remain historically high. However, supply is starting to leak in from the for sale market into the rental business. Again, this is caused by as more homes are put up for sale, owners are finding that the demand isn't there as the prices they expected. So what do? Well, realistic sellers cut the price. We've talked a lot about this on this channel. Realistic sellers will cut the price of their house. However, others are delisting their property to wait for market conditions to improve or becoming accidental landlords. 2.3% of the homes that were for sale this summer ultimately switched to rentals. So this is how the slow buyer demand market is causing more homes to hit the rental market. And so I know it's frustrating for some people to see that, like, maybe a seller lists a house and overprices it, and then they take it off the market, right? Like home delistings are up a lot year over year. Some people think, oh, that means the housing market won't crash. No, folks. That means that house is just going to end up on the rental market or is going to end up on the for sale market next spring. The inventory doesn't just go away. And the result is we're seeing overall disinflation in the single family home price market. I mean, folks, look at this graph. 1.5% single family rent growth, according to John Burns. That's the sixth worst rent growth we have seen since 1985. It's literally the sixth worst single family rent growth market in the last 40 years. That is telling you everything you need to know about where the overall housing market is heading. And John Burns isn't the only one observing this. RealPage, the big apartment data company who does the property management services, they're noticing this too. U.S. apartment market softens in August, according to RealPage. After showing resiliency in recent years, the U.S. apartment market saw the return of mild annual rent cuts in August as occupancy softened. Now, the occupancy rate is still 95.4%. It's still kind of historically decent. But how long is it going to be historically decent, everyone? With the downturn in immigration, with the immigrant work applications plummeting. This is something that I don't feel like anyone in the housing market is really talking about, is the issue with immigration. I don't know if it's just something that like everyone wants to plug their ears and just ignore. But we need to talk about it. Because if immigrant work applications were surging and were causing a temporary increase in rental demand a year ago, which prevented the rental market from crashing outright, and now these immigrant work applications are plummeting, meaning fewer immigrants are looking for work, which is definitely going to mean fewer immigrants are going to look for an apartment. I don't know, folks. I could see a situation where we have outright deflation across the entire housing market in 2026. Outright deflation across the entire housing market in 2026, which means negative rents year over year, negative home prices year over year. And ultimately, I think that's needed, right? That's needed for affordability. That's needed for the home buyers who've been waiting 3 or 4 years. That's needed for the renters who got smacked in 2021 and 2022 by those big rent increases 3 or 4 years ago. Yeah, the rents are going down now in a lot of markets, but they went up a lot 3 or 4 years ago. So we need this improvement in affordability. The other thing I think is interesting about this is potentially what it means for interest rates in the Fed policy. And Donald Trump actually appointed a new person to the Fed board. His name is Stephen Moran. He was in the Trump administration in the Council of Economic Advisors. He's now on the voting committee for the Fed board, Fed Board of Governors. And he was recently talking about how he thinks that the Fed is underrating how deflation could play out in the next 12 months and keeping interest rates too high relative to the situation that maybe there could be more disinflationary and deflationary pressures than the average person at the Fed or the average person in the economy thinks due to lower immigration and due to AI, right? Lower immigration is going to cause potentially disinflation, deflation in the housing market. AI seems to be also causing deflation across other sectors. So this is just like a really interesting thing to think about. It's good news if you're a home buyer, not so good news if you're an investor, right? So like we have to remember, everyone, what happened with the investors. We have to remember what happened with the investors during the pandemic. And this graph is showing you what happened with the investors during the pandemic. This is tracking investor purchases. This is data from Redfin, sourced from Redfin. They track investor purchases every quarter. We're looking at Tampa right here, and I can take basically your requests here and look at your market. But you can see in Tampa, right, the big increase in investor purchases in 2021 and the massive collapse since then. So investor demand in Tampa is down something like 60% from the peak, right? 60% decline from the peak. It's also down from pre-pandemic levels by about 30%. So investors are already like seeing this. Like landlords and investors are already seeing this. They've already stopped buying homes, largely due to interest rates going up, but also due to the fact that the rental market is not that strong, right? So, this is already a sign, right? Like in Nashville, the demand to buy investment properties has been cut by 55% the last 2 years. In Las Vegas, the demand to buy investment properties has been cut by 65% the last 3 years. Right? So we're already seeing these investors buying fewer homes. And folks, the reason I'm being kind of methodical with this and walking you through all these individual data sets is so you can get a full picture of what's going on in this market. There's a lot of people who keep trying to tell you that there is no housing downturn. There's a lot of people, I see them in the comment section. They try to say, "Oh, Nick, you've been talking about a downturn. There's no downturn." Folks, there's a major downturn going on in the housing market right now. Investor purchases are down 65% in markets like in Las Vegas. And now the rent growth is going negative and inventory is surging. All the signs are stacking up in these different markets to show you that, yeah, there's a downturn playing out, to show you that things ultimately are going to get cheaper for you in many of these areas. And let's take a look here at what the chat is saying. This seems to be a pretty active chat so far. What are you guys saying here about what's going on? Are you guys like renting? Are you guys buying? Let me know here in the chat. Let me know in the comment section. Like, are you planning to buy or rent? I actually did an interesting poll here I want to see the answer to. Yeah, I asked you guys a question earlier today. Do you rent or own? I asked you, do you own? If so, do you own one property? Do you own multiple properties, or do you rent? Well, half of you rent. 35% of you own and you own one property. 13% of you own and you own multiple properties. So I think it's interesting. We have 13% of people who are investors, right? Own multiple properties. Maybe they own vacation homes. Half of you rent. So, what are you guys seeing in your market? Let's see. Katie says home prices need to plummet. They are still up 3 times as much as 2022. Home prices down, mortgage rates down, rents down, insurance down. Everyone wins. I'm agreeing with you, Katie. I would not be surprised if in 2026 we see downward action on all of those things. Home prices down, rents down, mortgage rates down. I think that's a definite possibility. Stuntfish says, a large rental company in my area just took 100 rentals off MLS. They're trying to do anything to keep rental prices up. Yeah, I mean, you might still see that. Like, there's a lot of, people still trying to like take their rental off the market, take their home off the market. It's going to go back on the market in the spring, right? I mean, you can only do that for so long. Monty has a great point. Have incomes appreciated alongside all the other asset classes? The answer is no. Median incomes in the U.S. are up by like 22% the last 5 years. Home prices are up 45%. Jimmy says, great insight today. So much of what we've been saying for years. And on the STR side, rentals going to LTR and then selling too because the STR market isn't bouncing back. So STR is short-term rental, everyone. So if you guys are, fledgling investors, let's just talk about this. And, maybe you guys want to buy your home to live in. Maybe eventually you want to buy an investment property. I think a lot of people do eventually, want to buy maybe an investment property. You got to do the pro forma. You got to think about what you can get for the rent. And the big issue right now is that the cap rates are not where they need to be for investors, right? The rents are stagnating, maybe flatlining, maybe going down. The home prices are still high. So, investors trying to buy feel very similar to you guys as regular home buyers trying to buy. The math just doesn't work. And, it's this relationship between owning and renting that I just think is really interesting, right? Like if we want to ask the question, what's going on with the housing market? Is the housing market overvalued or undervalued? Right? We have to look at these other data points and we have to see, do other data points support the notion of where home prices are. And we have a data point here on ReventTrap called cap rate. This is a great data point to look at if you're an investor or a home buyer, but it's going to give you a good sense if the market's good to buy in. I'm just going to pick Denver for a second. Here's the market cap rate in Denver going back the last 20 years. You can see it was a 3.7% cap rate in 2005. Then it was a 5.3% cap rate in 2012. Now it's a 3.7% cap rate today. How can you interpret this cap rate data to know if it's a good time to buy in Denver? Well, let's compare the cap rate to the 10-year Treasury yield, the gray line, which the ReventTrap allows you to do. You can see the 10-year Treasury yield in August 2025 was 4.2%. For the last 3 years, the 10-year Treasury has been above the cap rate in Denver. That's a signal that Denver's market's going to struggle. Because from an investment perspective, from a landlord perspective, landlords can make more money investing in U.S. government bonds than buying rentals. And so long as that's the case, you're going to see a decline in demand. You're going to see an increase in inventory. So what are we seeing actually in a market like Denver? And I'll take your requests here in a second, everyone. In a market like Denver, the amount of homes for sale is now up to 13,000. We have the highest number of homes for sale in Denver going back at least a decade. We have a minus 9% forecast for Denver the next 12 months. A big reason why is the fact that the cap rates are just too low. 3.7% cap rate is not going to get it done in Denver. And then the buy versus rent differential also doesn't make sense. Costs $43,000 a year for you to buy a house in Denver in terms of your payment. It's about half that to rent. And so we see the cost to buy go way above the cost to rent. The purple line go above the green line. That's going to mean home buyers stay on the sidelines. That's also going to mean it's harder to buy an investment property. And the ultimate way to fix this, everyone, is for home prices to drop and drop significantly. That's the reality that still a lot of people in the housing market are trying to ignore. A lot of the traditional real estate mainstream who does the analysis is still trying to kind of bury their head in the sand on the reality of what needs to happen. I think more and more of them are starting to come to terms with it. I see it kind of in the mainstream news reporting. I see some people slowly but surely acknowledging prices are dropping and need to drop by more. But in reality, we can't, this is not going to work. This housing market's not going to work when the monthly cost to buy is $3,600, but the monthly apartment rent is $1,900. It's just not going to work. People aren't going to buy homes. Investors aren't going to buy homes. And we're going to need prices to go down to cause the market to re-stimulate. That's what needs to happen. Trap Music has an interesting comment. He says the stock market is doing better than real estate in the short term. That's true. The stock market is doing surprisingly well. Just keeps humming along. I think the earnings multiple for the stock market right now is near a record. I think it's at 2001 levels. Like I think the Shiller Cape Index is now at like 2001. The Buffett indicator. I don't know if you guys know what the Buffett indicator is, but it's an interesting thing to talk about the stock market. It basically takes the aggregate value of the U.S. stock market and divides it by U.S. GDP. So right now, stock market's 65 trillion, GDP is 30 trillion. That's 217%. You could see that we've actually never seen the stock market more richly valued than this compared to the size of our economy. So could the stock market also be in a bubble? I don't know, but I think maybe a high stock market's the only thing so far that's preventing more sellers from freaking out and selling their house. We have a comment from Briam. He says, debating whether to move to Central Florida, looking at Kissimmee or Cacao, or otherwise move to Metro Atlanta. Can you take a look at these markets and compare? Interesting. You're either looking to move to Central Florida or Atlanta. Well, I'll tell you actually where I would move personally, having lived in Florida and spending a lot of time in Atlanta. But let's just take a little look here. Central Florida. What's going on here in Central Florida? You know, this is a market where prices are dropping and rents are dropping here in Central Florida. So in Orlando, rents are down 4%. Or I should say home values are down 4% year over year in Orlando. In Lakeland, they're down 4.4%. In Ocala, they're down 3.1%. And we think these declines in Central Florida are going to continue into the future. In Orlando, we think prices are going to drop 7.1%. If we look at the data from Apartment List, we could see Orlando apartment rents are down 7.7% the last 3 years as well. So again, folks, I want to link this for you guys. Home prices going down? Well, rents are also going down. At least apartment rents are going down in Orlando, according to Apartment List. What about Atlanta? The request was also for Atlanta. Can we find Atlanta on this scatter plot comparing how much vacancy rates have gone up versus how much rents have gone down. Here it is. Atlanta rents are down 8.9%. Apartment rents are down 8.9% the last 3 years in Atlanta. 8.9% decline in apartment rents. Now, what's going on with the for sale market in Atlanta? The for sale market. Well, in the last year, Atlanta's down 3% on prices. And we think it's going to go down another 3.8% on prices. However, I would tell you guys, Atlanta's very bifurcated. So depending on where you are, right, there's going to be big differences in terms of what's going on. The northern counties are doing better. The southern counties are really struggling. Clayton County is down 7.8% year over year on home values. Generally, the wealthier areas in Atlanta are doing better than the more low income areas. And, I was I'm going to give you guys a little intel. So when I moved back from Florida to Tennessee about 2 months ago, or a month and a half ago, I wasn't actually sure if I was going to move back to Tennessee. I was considering actually moving to Atlanta. And I spent a decent amount of time in Atlanta. I have a lot of good friends there. It's a city I really like. Me personally, I think it's a no-brainer. Atlanta wins every day of the week over Central Florida if you are looking to move. Just from a personal perspective. I mean, the amount of options that Atlanta has for dining, nightlife, sports, um, business, networking. I was staying in Buckhead, in Atlanta. I don't know if you guys know that neighborhood. It's to the north. The corporate business presence there is insane in a good way. So I'm a big fan of Atlanta. I would move to Atlanta over Central Florida every day of the week, just on a personal level. All right. What else? Dean. Dean has an interesting comment. He pays $2,600 for a 2,200 square foot house with a 3-car garage in Henderson, Nevada. Same house in a bad neighborhood in LA would be $5,000. Yeah, LA rental markets. We have certain requests on the LA rental market. So let's take a little look at LA. I think what Dean is trying to do is trying to say Vegas is a lot cheaper than LA, which is true. Vegas is a lot cheaper than LA. However, Vegas rents are really affordable compared to the price to buy. Let's see. In Los Angeles, rents are down 1.9% the last 3 years for apartments. Vacancy is up 1.2%. So rents in LA are down a little bit. Vacancy is up a little bit. Not like a huge move like some of these other markets. Vegas is one that you folks should pay attention to because what we're seeing in the Vegas rental market is definitely concerning. Like concerning if you're a landlord, I should say. Great if you're a renter. So the typical rent in Vegas, everyone, is like $1,781 a month. It's basically flatlined the last 3 years according to data from Zillow. So the rents in Vegas went up a lot over 2 years during the pandemic, and then they haven't grown in the last 3 years. The issue for Vegas's housing market, though, is the difference between the cost to buy and rent. So in Vegas, the buy versus rent differential is crazy, everyone. It costs $2,700 a month to buy the standard house in Vegas. It costs $1,800 a month to rent. So while Vegas might be a lot cheaper than LA and might be getting certain people moving from LA because of that, the local on-the-ground dynamics for renting versus buying suggest that the Vegas for-sale market is going to struggle because the rental market is struggling. And this is another example where the rental market is feeding in to the for-sale market. So the demand to buy homes in Vegas is down significantly. The home sale activity in Vegas is down literally almost 45% from peak. We have the lowest buyer demand in Vegas in 13 years. If you were to talk to the average person in Vegas, they might say, what are you talking about? All the people from California are moving in. All the investors are buying. No, that's not happening anymore. The demand to buy in Vegas is really low right now because of that rent versus buyer differential, because the rental market is struggling there, because rents are dropping or stagnating. It's easier for tenants to just wait. It's easier for people to renew their lease and decide not to buy. Let's see. Okay, we got a super chat here. For the Atlanta shout out, you rock. Just bought my first home here for all the reasons you named. All right, so someone just bought a house in Atlanta. Congrats. Hopefully you bought in a good area, got a good price. I think Atlanta is a great place for the long term. Let's see. What else? Yeah, Vegas travel is down big for sure. Vegas tourism is way down. North Atlanta is very nice and expensive. That's true. Oh, we got a request for Houston, Texas. Houston's another market It's really interesting, everyone. Houston shares a lot of similarities to, say, Atlanta or Dallas, just like this big, big metro where there's a lot to do, good food scene, right? What's going on in Houston? What is going on in Houston? Can we find Houston in terms of its rental performance here? Where is Houston? Houston's definitely a more affordable market in general. Here, looking at the data from apartment list, where is Houston? Can we find it? Are rents down in Houston? Are they up? Well, the apartment rents are down 6.7% in Vegas. They're down 6.9% in Charlotte over the last 3 years. They're down 6% in Tampa. They're down, even in Knoxville, they're down 3.8%. They're even down slightly in Chattanooga. Where is Houston on this list, everyone? Ah, here it is. Houston, the apartment rents are only down 1.3% the last 3 years. In Houston, it's just a much more affordable market in general. Like, I actually kind of like Houston, everyone, for real estate purposes. I don't think it's going to crash in the same way that other Texas markets are already crashing. I mean, Austin's down 25% on home prices, 20% on rents. I think Houston is going to do a lot better than that. I think Houston's going to hold its values. But let's see, like right now, if you wanted to rent a house in some of these northern suburbs, like north of Houston, how much do you have to pay? I mean, first of all, folks, what did we just stumble upon here? This is crazy. Look at how many rentals are in this neighborhood. We talk about why are the rents slowing on a national basis? Why is the rental growth not so good? Look at how many rentals are here north of Houston. I mean, this is like, did all the investors just team up and buy properties here? 48 rentals compared to 11 homes for sale. Wow, and the homes for sale here are like 220 grand. This is crazy. This is affordable, actually. You could rent a house here in this neighborhood of Houston for $1,800 a month. 3 bed, 2 bath, 1,600 square feet. I mean, definitely not. I'm not going to call it the greatest house in the world, but you have a little yard, 3 beds. Um, looks like laminate flooring. 1,765 a month. You think that's a good deal? That's barely over $1 a foot to rent this 3 bed, 2.5 bath house. And you can see the rents have actually been cut quite a bit. They were around 1,900, then they've now cut to 1,750. Prior to the pandemic, they were 1,425. So this is like some interesting math you guys can do if you're looking on a listing and you're like, is this rent fair? Like, does this make sense? Well, October 2019, the rent for this house was 1,425. All right. Today it's 1,765. So in 6 years, this rent has gone up 24%. 24% increase in rent in 6 years, which is around 4% a year, about 3.5% a year compounded. That's reasonable. That's basically the rate of inflation. Income growth in some of these areas is higher than that. So I would say this is like an example of an affordable rental, right? And if you see this many affordable rentals in your market, it's a good sign actually for buying a house. It's going to mean that the people who are trying to sell are probably going to have to cut their price by more. Look at folks, 4 bed, 3 bath house for $206,000. I mean, this is crazy. Built in 07, $105 a foot. Your payment would be $1,300 a month. Is that right? Is that accurate? You can see the value of this house used to be $256. Now it's listed for $203. So the Zillow value in this house is down about 20%. They've had to cut the price. Wow, they originally listed it for $255. This was an investor. So this is like another great example, folks, of what's actually going on the ground. Like I was showing you the data on what's going on, right? Earlier in this video. Here's a listing in Houston that I just randomly pulled. This was an investor who's owned it for a while. They rented it for $1,600 a month in 2018. They increased the rent to $2,400 a month. Couldn't get it. Couldn't rent it for $2,000 a month earlier this year. What did they then do? They put it on the market for sale at $255. They've cut it to $206. Great example of how the sale market and the rental market are linked to each other. They are two sides of the same coin. And so if you're someone trying to understand your area kind of at a deeper level, right? We actually have a metric for you guys on Reventure app that I encourage you guys to check out. It's called the rent to income ratio. We have that rent to income ratio for almost every city and zip code in the US, and we track it going back 20 years. So you can look at that rent to income ratio, and it can help you discern whether it's a good time to buy, whether it's not a good time to buy. And I just want to run you through some of that data on the rent to income because it's a really important metric. It's under investor metrics here on Reventure app. You could see home value to rent ratio. Home value to rent ratio. So in Vegas, you can see how big the last bubble was. Home value to rent ratio was 23. Now it's 16. The long-term average is 14, right? So you can see Vegas's market is overvalued on the basis of rents. Vegas's market is overvalued on the basis of rents. So we're going to see downward pressure likely on home prices simply due to the fact that rents have not kept up with home prices. What are some other markets that we could look at that home value to rent ratio? One would be maybe Dallas, Texas. Are the rents in Dallas keeping up with the home prices? No. So today in Dallas, the typical home value trades for 14 times the annual rent for houses. You can see the long-term average is 12. So Dallas's market is overvalued on the basis of comparing home values to rents. Prices in Dallas are already going down. That's why there's been a slight improvement in the home value to rent ratio, but it's still way above this long-term average. At the bottom of the last crash, it was nine times. Home values were 9 times the annual rent. How about Nashville? In Nashville, the typical house trades for 16 times annual rent. Looks similar to Dallas. So you see basically almost identical to Dallas, this big surge, and we're at 16.4 times annual rent. The long-term average is 13.4. So these fundamental indicators, everyone, are really helpful for you as buyers, right? You're trying to make the decision, is now the right time to buy? Where should I buy? This is a metric, the home value to rent ratio, which is going to help you understand if your market is overvalued. If the home value to rent ratio is well above the long-term average, it's telling you you're in an overvalued market. Now you can combine this home value to rent ratio also with the home value to income ratio, because that's the other side of the equation. How does the home value to income ratio look? Oh, in Nashville, home value to income is also above the long-term average, and as a result, we have Nashville's market as being, how overvalued is Nashville? 20% overvalued. So this overvaluation metric is also going to help you guys a lot. I really believe in kind of the fundamentals, looking at the housing market from the fundamental level. We spend a lot of time on this channel talking about our forecast for the next year, which is very important. If you're buying a house, you want to know that forecast. What's the 12-month forecast? In Nashville, it's minus 6.9, right? So if you're making offers, make offers in anticipation of value declines. Share the fact with sellers that values are likely to drop. Negotiate a better deal. But just also understand Nashville's 20% overvalued in general from its long-term norms, home price to income. And so long as the market's really overvalued, you're going to see more likely of a decline in the future. Christina has a great question. Does the rent to own evaluate averages or equivalent housing? It evaluates the typical home value. So you could think of it as close to the median, like the median value, the median rent. It's technically between the 35th and 65th percentiles of houses and rental properties. So it is fairly similar, but it's not identical. So the average rental is definitely going to be smaller than the average house. However, the data is consistent throughout time. So if you see that average, that takes into account that average across the last 20 years. So if you're trading at a premium on home value to rent compared to the last 20 years, it's telling you objectively the market's overvalued. Bold has a great question. How do people live in California? I don't know. It's a great question. California is California is a beautiful state. I love California. Every time I go there, they call it California dreaming. I think, oh man, I should move here. Never was able to pull the trigger. I came close. I actually applied to an apartment in Los Angeles in August 2023. I was like, oh, I'll split time between Nashville and LA. Couldn't pull the trigger. Taxes are too high. It's too far away from family and friends. Here's an interesting question. Do you think it's worth paying $500 or even $1,000 more per month on a mortgage than rent since you're building equity over years? So this is I actually love this question. Thank you for asking this question, USA Master Plan. I want you guys to actually look at this question because this is a great one. It's something I see a lot of. Do you think it's worth paying $500 or even $1,000 more per month on a mortgage than renting since you're building equity over the years? Right? So this is another narrative for the housing market. It's like, oh, you're building equity if you buy, is what a lot of people say. I would answer that question with looking at the overvaluation rate. If you buy when the market's undervalued or fairly valued, yes, you have a good chance of building equity. However, if you buy in an overvalued market, you have a good chance of losing equity. So the idea of buying today to gain equity doesn't make much sense in most markets because most markets are overvalued, right? So if we go to Atlanta, Atlanta is 20% overvalued today. Are you going to gain equity in the next 3 years if you buy in Atlanta? I don't think so. I really don't think so. Like if you get an amazing deal, if you buy today, I think you maybe could be in good shape. You get a big discount, but you you shouldn't be you shouldn't be thinking that you're going to gain equity the next 2 or 3 years if you buy today, given how overvalued the market is. Could you gain equity over 10 years? Yes, right? Over 10 years you can gain equity. Over 20 years you can gain equity, but I don't think it's a good argument. I don't think you are going to gain equity in the next 2 years if you buy in today's market, especially if you buy in some of these more overvalued areas. Now, interestingly, folks, some areas are undervalued. New Orleans is undervalued. Maybe you'll gain equity if you buy in New Orleans. New Orleans is 12% undervalued today. Fair home value of 290,000, typical home value of 255,000. Should you buy in New Orleans today? Well, I don't think there's going to be a crash. I think, was talking to you guys about San Francisco recently. San Francisco County is 18% undervalued. Maybe you could gain equity if you buy in San Francisco. It's 18% undervalued. Another market where maybe you could gain equity if you buy today is, believe it or not, Manhattan. Home values in Manhattan are 29% undervalued. So these are just some of the markets that are undervalued, everyone, where income growth has outstripped home value growth. And actually, in New York, this is a funny one. In Manhattan, the home value to rent ratio, look at this, everyone, is at the lowest level on record. The home value to rent ratio in Manhattan is at the lowest level on record, meaning condos and co-ops are trading for the lowest premium ever relative to rents. Now, who knows what the new mayor is going to do in New York with different things on property taxes and things like that. But when you see the home value to rent ratio at an all-time low, that's actually the signal more generally that you should buy. So these would be the type of markets that you would gain equity in if you bought today. The ones where the ratios of home value to rent and home value to income are near the lowest level on record. Right. Let's see. Coors Light 2025 is saying, you know the rental market in California is soft when you start seeing landlords offer free months as an incentive to sign a lease. So far, no sign of that happening. Yeah, I mean, California's rental market is tighter than other markets. The free rent, the concessions is definitely a way to track that. This is an interesting question. If AI does replace many white-collar workers, what will it do to the housing market? Well, I'm not sold that AI is going to replace all the white-collar workers or many white-collar workers, but I think there's definitely something happening in the short term where people with white-collar jobs feel a bit insecure in their job right now. And if someone feels insecure in their job, what's the likelihood that they're going to take out a $500,000 mortgage, $300,000 mortgage? It's not very high. Wickham says, thinking about selling in 03102 and buying in Venice. What are your thoughts? 03102, what area is that? Buying in Venice, Northport. Well, Venice and Northport, Florida, folks, have gone through a big correction. So home values in Venice and Northport, Florida, down 10% year over year in Sarasota County. 10% decline already in home values in Sarasota County. We think there's going to be another 7.8% decline over the next 12 months. So good time to buy. I mean, the values are dropping. They've dropped 3 years in a row. They will continue to drop over the next year. So I would say it's a good time to buy in Sarasota, Venice area, Northport area. Just make sure you understand that the market's likely to continue to drop. So I would access the Reventure app forecast for your zip code. Go to www.reventure.app, type in your zip code, upgrade to a premium plan so you can see that forecast for your area, and then make a decision on where you want to buy and use that forecast actually to negotiate a cheaper price. Tim from Canada? Looks like Tim from Canada. just paid $232,000 and closed on a 1,300 square foot KB Homes townhouse 5 miles east of St. Augustine Beach. 32086 zip, 3x3 garage, no CCD, 165 HOA, 1,000-year taxes, paid 24 below asking price. I mean, folks, look, if you want to buy a house in Florida right now, like if you've been waiting, you can get deals. Look at this. Tim just bought a house for $232,000 brand new. 24,000 below the asking of 257,000. So again, folks, this housing downturn is happening in real time, right? It might not seem like it in every city or state, but in Florida, in Texas, and Arizona, I mean, there's some big discounts going for houses right now. Appreciate the message, Tim. Planning to buy in Leander, Texas, Raj. Planning to buy in Leander, Texas. Leander is north of Austin. Austin's in a free fall. I think Austin's actually becoming a good place to buy. So if we go here on Reventure app and look at our, let's look at our home value to rent ratio in Austin. See what's going on here. Home value to rent ratio in Austin. Ooh, still kind of high, actually. There could still be some downside on home values to rents in Austin. The home value to income ratio in Austin, and this includes Leander, Williamson County, is almost back to the long-term norm. So Austin is almost fairly valued relative to income. We think it's going to go down another 8% the next 12 months. But it's basically fairly valued relative to income in Austin. So I would say actually now is a good time to buy in Austin. So I would actually, I mean, negotiate hard though. Like prices are going to drop more in the future. All right, everyone. So summary of today's video. Rents are dropping in many markets. On a national basis, we have the worst rent growth in 13 years. Immigration's plummeting. It's likely we're going to see some housing market disinflation/deflation over the next 6 months, just in general, rents and sale prices. So ultimately, that's good news for you as a buyer. The question is, how much are values going to drop in your area? And to figure that out, go to Reventure app. Actually, download the Reventure mobile app, everyone. I'm just going to show you real quick here. The Reventure mobile app. Here, I got my phone out. And I actually use the Reventure mobile app all the time. And it's interestingly not impacted by the data issue today I was talking about before. But the Reventure mobile app allows you, let me just put that on the screen in front. The Reventure mobile app allows you to see all the data by zip code. You can download it in the iOS and Android app stores right now. And what you're going to want to do is you're going to click on the different zip codes and you want to check out that forecast in your market. Check out that forecast in your market over the next 12 months. Upgrade to a premium plan to check that out. Reventure mobile app is basically, when I'm not doing these live streams, that's pretty much how I use Reventure now, is through that mobile iOS Android app. So make sure to download it if you haven't already. Upgrade to a premium plan. Costs us $49 a month, which is ultimately great value compared to knowing where home values are heading in your market over the next year. Until